Hi guys. Okay, this video is to go over our Chapter 1 Practice Problems P1. I'm going to run through this with you. I don't recommend sitting down and doing this in one sitting. I would recommend taking like 3 problems a day. That's really how I would approach it. And that way, as you have questions, you can ask them. And so forth. Okay, so we click the arrow on the right, and I'm going to say begin. Now, we can see you have 2 check my work features. So you have 2 tries per question. So there's really, no reason to get points off, but if you need to do multiple attempts, you can as well. 25 points. So there are multiple attempts up to 3 tries. We'll click start. 12 questions. We could see on that page there was 12 questions. We can see down here 1 of 12. Now, I'm including these answer questions for your benefit, not to make busy work, not because I want to grade them. I don't. However, I think that it's really helpful for you to read the chapter and then see if you can, answer that question. And please, you don't need to regurgitate the textbook answer, okay? This isn't graded by the computer. I would like you to try and type an answer in English. It doesn't need to be tax lingo unless there's a term that absolutely has to be said in tax lingo. Say it how you would say it to a friend in conversation so that you get the most out of this and really learn it. And then, of course, check yourself in the book and make sure, is what I said really right? And you kind of have to decipher that tax lingo. And so on that topic, so that's a general thing about these discussion questions. Another thing I'll say is that I'll just talk quickly about the different types of tax rates. A progressive tax rate, and you can see this as kind of an example as well. A progressive tax rate means the rate increases as the base increases. By base, in our income tax system, that would be income. So as someone's income goes up, the percentage of tax goes up. A regressive tax is that as someone's income goes up, their tax rate goes down. A proportional tax rate would mean it stays the same. Now, if I asked you, what do we have here? You might want to say a progressive tax rate. However, the reality is that we often have a regressive tax rate, and we'll talk more about that in a moment. The problem with a proportional tax rate is it doesn't give lower income people a break from paying tax to cover their living expenses. So we technically have a progressive rate according to the tables, but because of how complex our tax system is and because of many loopholes that have developed over time, it's often regressive for many people who have the ability to pay more. I mean, I've seen many high net worth individuals, returns that I've done, they were paying 5 or 6% taxes. And that's why certainly some people in government are big proponents of raising the rate, is because of that loophole. However, raising the rate really isn't a good answer. It's really cutting off some of those loopholes and using AMT effectively. AMT is an alternative minimum tax, which kicks in to say, okay, there's a minimum tax you've got to pay, but unfortunately it misses the loophole people. All right, I'm going to click next. Sales tax. GET is a sales tax. Technically it's an excise tax, slight difference, but pretty much the same. This is a great exercise. You're going to look at table 1-3 and they're going to look at the implications of a flat tax. And we're going to look at our current statistics in the US. We talked about this. Now, Social Security, I'll tell you, I won't answer the question for you, but I'll tell you how Social Security works and you can review it here in the example here. Social Security only applies up to $118,000 of income. After that amount, it's gone. And so that's a regressive tax because the more income you make, the smaller a percentage that Social Security tax was. And that's because it was supposed to work like a retirement plan, and it really needs reform to make it more like a retirement plan. Unfortunately, because the government is so split about it, a lot of people talk about reform, and what they mean is they want to get rid of it. And the other people are trying to reform it to be like a real retirement system, which I think is a real solution, is to turn it into a required retirement system. That way it's backfall for people who don't have anything when they retire. Okay. Unemployment compensation, it is taxable. Did you know that? You can often need to call and get them to take out taxes when you're getting unemployment compensation. They don't do it automatically. And it's taxable. I'll let you look that up in your book as to why. But if you think about it, it's a lot like wages when you're being paid, which are taxable. Okay, so this is what I want to go over with you. Here we have Jennifer and Paul filing a joint return. They have taxable income of this amount, $128,000. And the following tax liability. So what they are showing us here is a calculation of taxes. So first of all, if you look in your book at table 1-2, these are marginal tax rates for married filing joint couples. And you'll look at that table, okay? Table 1-2. And then you find the range that includes 128,000. So the first section is up to 19,050 is 10%. 19,000 to 77,000 is 12%. 77,000 to 165,000 is 22%. So that one included their taxable income. Their taxable income is between 77,000 and 165,000. I'm leaving off the change. And so if we look, that's 22%. Now, let's say you wanted to get to this section in the book. You don't have your book. Click ebook. And awesomely enough, it is going to take you directly to the section that we're looking at here. Connect really is helpful. So it's opening. We'll X out of this to close this window. Let's see, we should have a few other features. Ooh, this is a map so that you can click around in the questions. And there's supposed to be a way, this is how we check our work over here. We have to make a selection first. Okay, marginal tax rate. So of course, you should have read this in the last assignment. If you need a refresher, you can freshen up. Here we see them referring to table 1-2, so I'll click that link. And here's that table. So taxable income up to this amount is taxed at this amount. Taxable income in between 19,000 and then 77,000 is this amount. Kind of annoying. Okay, so you find that is the taxpayer's marginal rate. So our taxpayer is between 77 and 165. So their marginal rate is going to be 22%. However, that's the answer to the question. Their marginal tax rate is, so we'll select 22%. Remember, you get to check your work, so you could check your work to see if it's right or not before even submitting. Oh, look at that, we are right, we can submit. But back to this tax liability calculation. So to understand how this is working, see these amounts over here. These are directly from the table, 19,050 times 10%. Because out of this taxable income amount, the first $19,050 is taxed at 10%. Then the amount between $19,051 and $77,400 is taxed at 12%. And we can see that amount right here. That comes out to $7,002. Then our last bracket, we're not above 315,000, right? And we're not below 100 and, oh wait, I'm sorry. I'm on the wrong one. We're not above 165,000. We're not below 77. So we need to figure out what amount of this, how much do we have over $77,401 that needs to be taxed at this 22%. So you can see we've got the amount from the first bracket, the full amount from the second bracket. We just subtracted the end number from the 19,050. Because that was accounted for in this first row, and $7,002. Now we take our total taxable income minus the beginning amount, because that is the amount that we've already accounted for in tax in these first two rows, and we times it by the 22%, and that gives us $11,135. So our total tax liability is all of these added together. Cool. That's how it works. Now, there are tables that we'll learn about later where you just literally go to, we'll explain those tables then, but they're a bit easier. You don't have to do that, but the textbook wants you to understand that this is how the tax works. This is another similar problem. I wanted you to have a chance to practice it again. Now, this is a concept that is often misunderstood, okay? People will say, I want a refund. The way people talk about refunds and owing money, it's like they don't understand this concept right here. So Elizabeth determined that her tax liability was $3,785. How did she determine that? Think about it. She filled out her tax return on April 15th, 2019, or 2018, for 2017. However, during 2017, her employer withheld $3,525 from her paychecks. So she has an actual amount due of $3,785. Her employer withheld $3,525. What is the result? Does she owe money? $3,785 is more than $3,525 that her employer withheld. Those were estimated payments. So she owes, right? She has a tax due of $260. If it had been switched, if her employer had withheld $3,785 and she had a tax liability of $3,525, then it would be a refund because she had more withheld from her paychecks than what was calculated on her return. Done. Be sure that if you use that check your work thing, you've got to click submit after. Your results. Yay, we're correct. Okay. Oh, that submitted everything. Oops. Okay, good to know. Good to know. So apparently you don't have to submit everything. You can just click check your work. Okay, there's one more question I wanted to go over with you. This question. So determine the average taxable income per tax return for each of these ranges of taxable income provided using information in the table below. So these tables were really interesting. They had averages from 2015 through 2018 in the book here. I'm not sure what year this one is for, but it's pretty interesting. So these are showing for each tax bracket. under 15,000, 15,000 to 30,000, 30 to 50, 50 to 100, 100 to 200, 200 or more. So this must have been a prior year. These are the number of returns that were filed in that bracket. So the total is all of these returns. And then the total amount of taxable income for these tax returns is right here. The total amount of tax liability for these tax returns is this amount. And the average tax rate is this amount. So you can see here, right? People earning over 200,000, their rates go from 24% up to 40% in the past. And yet the average is only 27%. And that's because some people are paying the full amounts, some people are not. And so you can see 10 to 200,000, I'm sorry, 100 to 200,000. It's not an exact range, but 16% is still pretty low considering the bracket. So you can see here, the point of these averages, if I didn't state this clearly, average tax rate is tax liability, this amount, divided by taxable income. And that is different, right? Because you just saw how we calculate taxes using a marginal rate. You're not paying that percentage on all your income. You're paying 10% on the first 19,000, just like everyone else. 12% on the 77,000, etc. Also, taxable income, I mean, it's not affected in this average tax rate, but taxable income is a lot less than total income because you get a standard deduction and different exemptions, sort of. A lot of that changed. We'll be talking about it. But there's quite a bit of deductions that people get to take. So you may not actually be paying tax merely on your total income either. Okay, so to fill this out down here, they're telling us determine the average amount of taxable income per return for each range. So this is the under 15,000 range. So here we need to determine taxable income per return. So how would we do that? We have 34,703,083 returns, and then this taxable income of 21,397,28. So we need to divide the number of returns divided by the total taxable income to come up with an amount per return. Okay, my phone isn't working right now, but you can do that part. Now it should make sense, right? Maybe I'll do it with you. Whichever number you divide first, it should make sense. So we'll do taxable income 21,397,029 divided by 34,703,083 for returns. And that gives us 0.61. So that's not correct. That can't be correct because there's no way that, although these are in thousands, rounded to the nearest dollar. So that means that taxable income and total tax liability are in thousands, which means we have to add another 3 zeros. Those are some big numbers, huh? So let's do income first. 21,397,029, and then we'll add 0, 0, 0. Divided by number of returns, 34,703,083 equals 616. Taxable income per return. So let's see if that works. How would we check it? If this is the right answer, $616, which seems awfully low, We'll times this by 34,703,083, and then add 3 zeros. And what do we get? We get 21,397,029,000,000, which is an extra zero. Okay, so I think I did the zeros wrong. So here's what we're going to do. We're going to do it again. So let's say we had 5 returns with $100 of income. We would do, let's say we had 5 returns that totaled $5,000 of income. If we wanted to find out what the average was for that, we would do 5,000 total income divided by 5 returns, and that would give us 1,000 per return. So for this one, we need to do total income first, divided by the number of returns, and then that will give us taxable income per return. 21,397,029, and then they said in thousands, so 1, 2, 3. Divided by 34,703,083. 000, which gives us let's see. Taxable income and tax liability are in thousands, not the number of returns. That's why. And it's $616.57. That's the average amount of the returns, which we can see right here is correct, 616. That's the answer. So I don't know why the answer is showing. Hide that. But anyway, so that's your formula. So my mistake was I was adding zeros to the tax return numbers. Only taxable income and tax liability are in thousands, so you need to add 3 zeros. And then you want to divide the amount by return. So total amount of whichever one you're doing, because the next question, I don't know why it's showing the answer. I think it is. I'll have to look at these settings. Anyways, this one is different, and it's going to ask total tax liability per return. So you can play with these. They're interesting to kind of see the numbers as well. And that's pretty much all. The last one is the tax formula. This it starts with income, and then you need to choose a plus or minus here. And there's a little drop down thing here. My computer is freezing up on me, and I want to end this video before it gets too long. But this you can look up. This is the basic tax calculation in the book. And then the last question is filing status. Okay, I'll see you next time.